Most traders think the reason they are not profitable is because their account is too small. They think, if I just had more money, I could finally make real profits. And that thought is so common, it feels true. But it is usually backwards. Because for most retail traders, trading big is not the shortcut to profitability. Trading big is the shortcut to blowing up. And trading small, the thing that feels pointless and slow, is often the fastest path to becoming consistently profitable. Let me start with a scene you probably know. You open your trading app and you see your balance. You do the math in your head. You think, if I make 1% today, that is nothing. Then your brain offers you a dangerous solution. Just size up. You tell yourself you will be careful. You tell yourself you will use a stop loss. You tell yourself you will only take good setups. And then you enter a trade with size that actually matters to you emotionally. And the moment it matters, you are not the same trader anymore. Your heart rate changes, your breathing changes, your attention narrows. You start watching every tick like it is a personal message. A tiny pullback feels like disrespect. A normal wick feels like betrayal. And now you are not managing a trade based on your plan. You are managing your emotions. This is the part people do not want to admit. Most retail traders do not lose because they do not know what a good setup is. They lose because when the size is big, they cannot execute the setup the same way. So this video is about why trading small is more profitable than trading big. Not because the market rewards small accounts, but because small size changes your brain. It turns you from a gambler into a professional. And by the end, you will know exactly what trading small actually means, how to choose the right size, and why this one decision fixes more mistakes than any indicator ever will. Let me tell you a short story. We will call him Ryan. Ryan started trading crypto like most people do. He saw people online posting profits. He watched a few strategy videos. He learned basic chart patterns. And he had one obsession, making it worth it. He did not want slow progress. He wanted that feeling of a big win. So every time he funded his account, he felt pressure. Pressure to make money quickly. Pressure to prove he was not wasting time. At first, Ryan traded small, not because he wanted to, but because he was scared. He would risk tiny amounts and the trades felt boring. He could take a loss and shrug, but he also felt like it was pointless. So eventually he decided to take it seriously and size up. The first day he sized up, he actually won. Big win. He felt unstoppable. He thought, finally. This is what trading is supposed to feel like. And that one win became a trap because it taught his brain that big size equals success. Then the next day, he took a loss. It was not even a huge loss in percentage terms, but because the size was big, the emotional impact was massive. His brain treated it like danger. Suddenly, he felt the urge to fix it immediately. So he entered another trade quickly, not because it was a great setup, but because he wanted relief. That second trade went against him too. Now he felt something worse than fear. He felt urgency. He felt embarrassment. He felt that tight feeling in your chest that makes you do stupid things. And this is where accounts die. He moved his stop loss. He widened it. He told himself it needs room. He stared at the screen, not thinking, just hoping. Then he closed the trade at the worst possible moment, right before it bounced. Now he felt rage. Not at the market, but at himself. And rage creates the third trade, the revenge trade. By the end of the day, Ryan had taken 3 trades that were not part of his plan. His strategy did not suddenly stop working. His execution did. And the reason his execution broke was not because he forgot what to do. It was because the size was too big for his nervous system. That is the first uncomfortable truth. Trading big does not just increase your profits, it amplifies your personality. It amplifies your impatience, your fear, your greed, your need to be right, your need to feel in control. Big size turns small weaknesses into account-ending mistakes. And trading small does the opposite. Trading small gives you room to think. It gives you room to execute. It gives you the ability to follow your rules without your emotions hijacking the wheel. Now here is the trap most retail traders fall into. They confuse seriousness with size. They think, if I am trading small, I am not serious. But in reality, professional trading is serious because the process is strict, not because the size is big. Let me explain the difference between an amateur and a professional. An amateur trades to feel something. They trade to feel excitement, to feel hope, to feel like they are making progress today. A professional trades to execute a process. They measure success by how well they followed their plan, not by how intense the trade felt. And here is why trading small is more profitable for most people. It makes it easier to act like a professional. When your size is small, you can actually do the boring things that make money. You can wait for your setup instead of forcing trades. You can place your stop loss where it makes sense instead of where it feels safe. You can take a loss and move on instead of spiraling. You can hold a winner long enough to hit the target instead of grabbing profit early out of fear. Those behaviors are profitability, not the strategy itself. Now let us talk about the most important concept in this entire video, the emotional stop loss. Every trader has two stop losses. They just do not realize it. The first is the actual stop loss on the chart, the price level where your trade is invalid. The second is the emotional stop loss, the point where you stop thinking clearly. Most traders size their trades so that the chart stop loss is acceptable, but the emotional stop loss is violated instantly. Meaning, yes, they can afford the loss financially, but they cannot handle the loss psychologically. And when your psychology breaks, you do things that are far more expensive than the planned loss. You revenge trade. You overtrade. You increase size. You move stops. You break your rules. So the correct position size is not what you can afford. It is what you can execute. Here is a simple test. If one losing trade ruins your mood, your size is too big. If you cannot sleep because of a trade, your size is too big. If you are checking the chart every minute, your size is too big. If you keep moving your stop loss, your size is too big. If you take profits early because you are scared, your size is too big. Because the moment your emotions control your decisions, your strategy is irrelevant. Now let me give you another story because this is where the lesson becomes impossible to ignore. Imagine two traders with the same strategy, same entry criteria, same stop loss rule, same target, same win rate, same everything. Trader 1 risks 1% per trade, Trader 2 risks 5% per trade. On paper, Trader 2 should grow faster, and they might for a short time. But in reality, Trader 2 is much more likely to break the system after a few losses. Because losses are not just numbers, losses are feelings. After 3 losses, Trader 1 is mildly annoyed. They are still calm enough to follow the plan. They take the next trade normally. Trader 2, after 3 losses, feels like they are in danger. Their brain triggers survival mode. And survival mode does not care about your strategy. Survival mode wants relief. Now Trader 2 starts improvising. They skip rules. They revenge trade. They trade when they should not trade. They chase moves. And now their edge disappears. This is why trading small is often more profitable than trading big. Not because the math is better, but because the behavior is better. The biggest advantage in trading is not having a high win rate. The biggest advantage is being able to execute your system the same way when you are winning and when you are losing. Most retail traders cannot do that with big size. Now let us talk about why trading small actually makes you learn faster. Because people say the opposite. They say, if I trade small, I will not take it seriously. That is wrong. Trading small allows you to gather high-quality repetitions without trauma. If every loss feels like a disaster, you do not learn. You react. You become emotional. You become defensive. You start blaming the market. You stop being honest in your journal. You avoid accountability. Small size keeps you honest. It keeps you analytical. It lets you review trades like a coach watching game film instead of like a person reliving a nightmare. And this is why trading small is the fastest way to build confidence that is real. Not confidence from one lucky win. Confidence from proving to yourself that you can follow your rules for 30 days straight. Now here is the part that will feel like a personal attack, but it is said with love. Most people want to trade big because they want to feel important. They want trading to feel like a movie. They want the adrenaline. They want the story. They want the identity. But if you want to be profitable, you have to accept something boring. You are not here to feel important. You are here to execute. Trading small is not just a money decision. It is an ego decision. It forces you to stop fantasizing and start practicing. And practice is where the money comes from. Now let me give you the practical framework to actually apply this, because this is not a motivational video. This is a blueprint. Step 1. Choose a size that keeps you calm. A good starting point for most retail traders is a risk per trade so small that it almost annoys you. Because if it annoys you, it means your ego is still trying to make trading exciting. That is perfect. You want to train discipline, not dopamine. Step 2. Set a maximum loss for the day. Because the day you trade big is usually the day you try to win the day back. A maximum loss rule prevents that. It turns trading into a professional routine instead of an emotional war. Step 3. Measure success by execution, not profit. For the next 30 trades, your only goal is to follow your rules. If you do that, you are winning even if the trades lose, because your edge is not the outcome of one trade. Your edge is the quality of your decisions over time. Step 4. Size up only after consistency. Not after a winning day, not after you feel confident, after you have proof. Proof means a journal. Proof means a track record of following rules through wins and losses. If you cannot execute small, you will not execute big. You will just lose bigger. Now here is the final paradox. The traders who become profitable are usually the ones who are okay making less money at first. They trade small, they build discipline, they build a process, they build trust in themselves. Then, when they size up, they do not panic, they do not chase, they do not break rules. They simply do the same thing with more capital behind it. And that is when trading starts to look easy, not because it is easy, but because the person has changed. If you take nothing else from this video, take this. Trading big does not make you a better trader. It reveals the trader you already are. And if that trader is impulsive, impatient, emotional, or inconsistent, big size will expose it and punish it. Trading small is the training ground. It is where you build the version of yourself that can handle pressure without breaking. And that version of you is the only thing that actually makes trading profitable. So the next time you feel that urge to size up because you want it to be worth it, remember this. The goal is not to make one trade worth it. The goal is to make your process repeatable. Because the most profitable traders are not the ones who trade big. They are the ones who can trade the same way every day, whether they are up or down. And for most retail traders, the only way to become that person is to trade small first.